Hi everyone, myself Abhishek Srivastava from Bajaj Finance Limited. So I guess the whole public is waiting for this another session. So once again today, welcome to you all for the another webinar session by Bajaj Finance Limited. So today we are having Mr. Arun Sundaresan from Nippon AMC. So welcome, sir.
Thank you, Abhishek. Good evening to everyone. Pleasure, talking to everyone.
Right. So, guys, just let me tell you about a little bit of a brief about the Mr. Arun. So, Mr. Arun has a total experience around 20 years in this financial industry only. And if I talk about the experience within the Nippon India Mutual Fund AMC, that is approximately 90 years, 19 years. And he's holding a various position in this company, like sales and distribution function, and had a stint at a corporate strategy function. And if I talk about his last role, so he was heading the product management and investor relation, and currently he moved to development and growth of passive business, that is ETFs, exchange traded funds, and index fund. He also lead sustainability and CSR efforts in the company. He holds this certificate in ESG investing, recognized by UNPRI and administered by CFA Institute, that is Chartered Financial Analyst Institute. Not only this, he has done his BE honors chemical from BITS Pilani and followed it up with postgraduate diploma in entrepreneurial management from TA Pi Management Institute, Manipal. So, as I already mentioned, that he also earned the right to use this CFA charter from CFA Institute, USA. So I think that's a great experience, sir. That I'm sure that this is going to be beneficial for all the investors and all the viewers are going to utilize your knowledge in their field as well before investing, right? So, so before sir, I will not take much of time. So before starting this session, so I will just brief about this. What is overall this index fund, NFO, and what we are going to present here. So post that, I will hand over the session to you, sir. So, to everyone, if I'll talk about index funds, as you know that we are here for the webinar session on the index fund. If I'll talk about index funds, what is index fund? So, an index fund is a type of mutual fund or exchange traded fund that tracks the performance of a specific market index by investing in a same stocks or assets as the index is. If I'll talk about the returns, so it aims to match the index returns. So, index funds are basically designed to provide a broader market exposure with a low operating expenses and a passive investment management. So now, if I talk about the NFO, so we are going to launch this NFO by Nippon AMC. So what NFO stands for? So NFO stands for New Fund Offer. It refers to the first-time subscription offer for a new scheme or mutual fund being launched by an asset management company to the public. And during the NFO period, an investor can subscribe to units of the fund at the offer price. Typically, it will be around 10 rupees per unit. And after the NFO closes, the fund is launched and it operates like other mutual fund with its unit price based on NAV, that is net asset value. And NFO are often launched with a specific investment objective, themes, or strategies in mind, and they offer investor to invest in new fund that might align with their financial goal. So if I'll talk about the NFO which Nippon is already has launched, so that is Nippon India Nifty 500 Equal Weight Index Fund. If I'll talk about this little bit about, so this fund is designed to capture the growth potential of all components part of Nifty 500 Index to achieve your long-term goals. So I will not take much of time regarding this. So we have once again, so welcome Mr. Arun Sundaresan. So Mr. Arun will tell a detailed discussion on. Will have detailed discussion on this, and he will tell about this one, and definitely it's going to be beneficial for all the investors. So hand over to you, sir.
Thank you, Abhishek. Is it audible, clear?
Yes, sir. Perfectly fine.
Okay, great. So, can I have the presentation also loaded? Someone in your team can put the slides
Yep.
And will I have control on this? Like, if I can I move this?
Yes, yes, sir. You can.
So how it doesn't go forward? So how does it? It's not moving actually. Abhishek, this is not moving. If I have to move these slides, what do I do?
No, no. You- we will move this
Sir,
slide.
I have you have uploaded. I can see only one slide, sir. This is Megha.
Yeah, Mega. So this is the first slide, right? So is it moving now?
Yes, yes. Now it's moving.
Okay. So so good evening once again. As Abhishek just mentioned to you, we are here to talk to you about a new fund offer called as Nippon India Nifty 500 Equal Weight Index Fund. So this is a index fund, as you realize. So therefore, I'll spend a minute explaining what index funds are and what are the advantages of index funds. Can you just call Sailesh and tell him that I'll call him back in the meeting? Sorry. So Abhishek just mentioned that index funds are mutual funds, just like any other mutual fund. Index funds are mutual funds, but the main difference is that we will simply invest as per an index. So suppose you have Nifty 50, and Nifty 50 has a particular stock. It has so much weightage. Then there is a second stock. It has this much weightage. We will simply invest as per that particular index. We will not decide whether to invest more in a particular stock. We will not decide that let us sell this stock because I feel I my view about the stock is this. So those things do not happen. It will exactly track the index. So this is number one. And as I said, they are also open-ended mutual fund, which means that any point in time as investors you can decide to buy or sell, just like how you do any other mutual fund. And the other advantage is that in a single fund you get to buy multiple stocks, therefore you get diversification through a single unit. Generally the expense ratio tends to be lower, relatively less when compared to the normal active funds, right? So this is another feature. And the performance will be subject to tracking error and expense ratio, etc. The performance will be very close to the index. Suppose Nifty 50 gives 20% return, the return of the fund, the index fund also will be very similar, maybe slightly lesser, but it will not be different from the underlying index. So that is another advantage. And the last but important advantage and the differentiation is that you know very clearly upfront what you're going to do. Suppose you choose to invest into, let's say, the mid cap 150 index fund. So you know that this is the mid cap fund. You know that it consists of 150 stocks, and you know the weightage. And this transparency, which you know upfront, remains the same throughout. So the fund remains true to label at any point in time, now and forever. What you intended to invest into, suppose you invested into a mid cap, forever it will remain that way. The style and the method, other things will not change over a period of time. So these are big advantages of index funds. And another important thing I wanted to point out to you is the fact that index funds, the passive offerings, uh, have a lot of unique and interesting propositions. In fact, a lot of strategies which offer differentiated risk return, which normally you may not find in the market. So that is also an advantage, and we are going to talk to you about one such offering today, which is the equal weight strategy, right? So introducing this equal weight index. So what does equal weight indexing mean? As the name itself suggests, it's very simple, right? So if you take, for example, Nifty 500. So Nifty 500 has 500 stocks, right? So all of us know that Nifty 500 has 500 stocks, but Nifty 500 is a broad based index, which means that the weight of each stock in Nifty 500 will be done as per the market cap. In other words, the investment will be made as per the, to be precise, free float market cap. The bigger stocks will have higher weightage. For example, HDFC Bank is the largest weight by way of free float market cap. So that will have about 6.5% weight, followed by Reliance Industries Limited, ITC, and so on and so forth. So the weight of each stock will be based on the size of the company, free float market cap, and that is the approach that Nifty 500 or Nifty 50 mid cap, all of these market cap based, broad based indices take. On the other hand, equal weight indices, in contrast to that, do not go by the size of the company. They invest equally in all the companies, regardless of the size. So, this is the main difference between a broad based index like Nifty 500 and, in our case, equal weight. In our case, what we will do is, in all the 500 companies, in all 500 stocks, we will invest equally, that is 0.2% each. I repeat, 0.2% each. So I gave you an example of HDFC Bank where in Nifty 500 at 6.5%, but here we will invest only 0.2%, in RAL 0.2%. Likewise, in every stock of Nifty 500, we will invest 0.2% in all of them, right? So this is point number two. The indices will be rebalanced periodically, meaning right now I invest 0.2%. At some point in time, the stock could do well, or relatively the performance can change, and it can become, the weight in the portfolio can become zero point 0.3 or 0.17, like that. But these indices will have, the equal weight index will have periodic rebalancing, which we will come to the detail. So at those times, it will again be brought back to zero point 0.2, so that at every point in time you have equal weight, and it does not move towards one stock becoming larger, the other stock becoming lesser. So essentially what will happen is that if you're investing in 500 stocks, you create 500 opportunities. The performance of the fund, the portfolio, will will be dependent on all the 500 stocks. It will not be dependent on a few number of stocks. A few large companies will not determine your risk and return. For example, a particular large stock, if it underperforms, your performance could get impacted. That will not be the case here. The entire set of 500 stocks will contribute equally to your performance. It will contribute equally to your risk and return. So about the index, Nifty 500 equal weight index, it's very simple. The concept is very simple. Nifty 500 is the base. So out of that, we will invest 0.2% in each of them. I mentioned to you already. This will have a rebalancing frequency every quarter, which means that once every quarter, it will be brought back to 0.2%. In the meantime, suppose I invested zero point 0.2, if it had become 0.3, 0.35, that stock will be sold to the extent that it will be brought back to 0.2%. So it's very, very simple concept, easy to understand. Index reconstitution, meaning there will be a few stocks in the index which for various reasons might move out of the index, and a few other stocks could replace. So this is again a common phenomena in index. For example, in Nifty 50 mid cap, in all the indices, this happens, and this frequency is once in 6 months, right? So those are the characteristics of this index. As you would appreciate, it's a very simple, straightforward, easy to understand index. By doing this, what are you going to get, and how is it different? One, as I said, no single stock or a few set of large stocks are going to unduly skew your risk and return. All the stocks are going to contribute equally. So therefore, you have equal opportunity. The portfolio, and you will see by a lot of data later on, is far more diversified. you're investing in across all 500 stocks. So therefore, it's a broad market investing. It's fairly diversified, and in this case, you will be investing across the market. So you will get exposure to large cap, mid cap, and small cap. So we'll come to all of those details. So it's a broad exposure that you will get across the market. Now, the other point, as I said, all index funds are rules based, meaning in this case, we will invest based on equal weighting. So that's the rule, and there is a rebalancing rule, reconstitution frequency, and all of that. So it strictly follows that at no point in time we will take a call saying that I think the stock is going through some trouble. Let me take out. Let me invest more in this stock. Those decisions are not made. We will simply be replicating an index. The second most important thing is, what are you going to get by investing in this fund? What you will get is a exposure which is possibly very different from the market. Many of you would understand that out of 500 stocks, the top 100 stocks are considered to be large cap stocks, meaning they are large sized companies, the top 100 companies. So 100 out of 500 is 20%. So you get, by investing in this fund, you will get 20% exposure to large cap. The next 150, that is 101 to 250 stocks, they are considered to be mid cap. By investing in them, you get 30% exposure to mid cap, and the remaining 250 stocks are considered to be small cap. So you get 50% exposure to small cap. So basically, you get a 20, 30, 50 split: 20% large cap, 30% mid cap, and 50% small cap. So this is the market cap split. And as I said, there is a rebalancing. So in some way, it is like a periodic profit booking. There is a particular stock you started with zero point 0.2. It has done relatively well, and suppose it becomes 0.3. In a way, you sell the excess, you book that profit, and reinvest into the rest of the portfolio in the same proportion as 0.2% each. So that is the periodic profit booking that we are talking about. So by doing this, what do you get, and how is it different from investing in, let's say, we talk about Nifty 500 in this case. So Nifty 500, even though it consists of 500 stocks, the top 100 stocks, because Nifty 500 is market cap weighted, the larger companies get a higher weightage. The top 100 companies account for almost 74% of the weight. I repeat, the top 100 companies, which are all large cap, account for almost 74% of the fund or the portfolio. So even though you may think that I'm investing in 500 stocks, essentially almost 74% of your fund, your investment, is going only towards large cap, and only the remaining is going into mid and small cap. So a few stocks are actually significantly contributing, and it is tilting your portfolio, and they account for much of your risk and return. On the contrary, in this equal weight, the top 100 stocks would account only for 20%. So again, 74% large cap, here you will get only 20%. So that is the difference. Even in terms of stocks, for example, out of the 500 stocks, the 20 stocks, the top 20 stocks in Nifty 500, which is just 4% in terms of stocks, right? These 4% of stocks account for almost 43% of the portfolio in the case of Nifty 500. Whereas in the case of Nifty Equal Weight, which is a fund that we are talking about, these stocks will account only for 4%. So there is a big difference. Not only is the market cap split, this 20% large cap, 30% mid cap, and 50% small cap, a unique combination. But within that also, because of market cap weighting, the difference in the weighting methodology, you have a very, very different portfolio, and you have a very different risk return profile. So just to sum up, the Nifty 500 has almost 70 to 75% exposure to large cap, about 18% exposure to mid cap, and about 10% exposure to small cap. The Nifty equal weight is actually exact opposite, so to say. Large cap exposure is 20%, mid cap is 30%, small cap is 50%. So you can notice how different it is. even though we're talking about Nifty 500 here. So that is how different they are. So these are the sector exposures here. Financial services is 18, capital goods is 12%, healthcare is 9.5, and so on and so forth. This has exposure across 21 sectors and fairly diversified. And you can look at this particular chart. The red lines are sector exposures in Nifty 500 equal weight. You can see how this, when compared to Nifty 500, Nifty 500 has nearly 28% exposure to financial services, some sectors more, some sectors very less. Here it is to that extent far more diversified when compared to Nifty 500. Now, coming to the next part of our performance of our presentation, we are showing you some past performance of the index. Even though this index has been launched just now, and we are the first and the only ones to launch a product on this right now. But the index data is available from 2005 onwards, so almost 19 years data. So in this section, we'll be showing you past data. Please note that past data does not mean past performance, does not mean your future performance will be like this. But however, it will give you some perspective as to what could potentially happen, and you can have the benefit of hindsight. So we are comparing the Nifty equal weight performance with some of the other equal weight index. I'll skip this part. Have a look at how the equal weight index, the Nifty 500 equal weight index has done. This is data as of July 31, 2024. In the last 1 year, this has given 56.6% return. Last 3 years, it has given 25.9% CAGR, and last 5 years, it has given 30.6% CAGR. Against this, Nifty 500 has given 39.2 in the last 1 year, 21% in the last 3 years, and 22.3 in the last 5 years. So this is Nifty 500. Just as a reference, Nifty 50, which generally people consider as market. Today also we say market is at a historic peak, and what you refer to could be Nifty and Sensex. So Nifty during the same time has given 27.8. The 3 year return is 17.9, and the 5 year return is 18.9. So very clearly you can see the outperformance at this point in time, the last 1, 3, 5 year, 7 year returns, etc. Now moving on. So what I just showed you is data at this point in time, but a lot of time it also makes sense to look at long-term data. So what we have done here is that in the last 19 years, how this strategy has done vis-a-vis Nifty 500. So what comes out is that on an average, the Nifty 500 equal weight generated 23% return, calendar year return, and on an average it has outperformed Nifty 500 by 3.8%. And more importantly, the strategy seemed to have done, again with the benefit of hindsight, in the past it has done exceptionally well in those times when in general markets have done well and there is widespread optimism. In those times when the market breadth has been positive, there has been a broad-based rally, mid cap, small caps have done well. For example, 2009, when Nifty 500 itself did extremely well, 90% return in that calendar year, this strategy gave 133% return. Likewise, in phases like 2014, 2017, 2021 after COVID, the last 1.5, 2 years, when in general markets have been doing well, those times this strategy has done very well. On the other hand, during difficult times when markets have been narrow, or when there is a risk aversion, when there is a few set of stocks doing well, equity in general has not been performing well, this strategy tends to underperform Nifty 500. So as investors, you need to keep both of these things in mind. Yes, in the longer term, the strategy has given good returns, it has outperformed, and the track record is good, and it has done well, especially in those phases where there is optimism, there is broad-based market movement. But at the same time, it has also underperformed in periods where there has been negativity in the market, or there is narrowness in the market. So you need to consider both of these things together, and take a informed decision about how you want to go about investing in this particular fund. So rest of it we have given details. I'll skip all of that. Like any other mutual fund, you can also make SIP, systematic investment plans, also in this particular fund. And the long term track record in terms of returns, in terms of the experience, has again been good over a period of time. The last 1 year return on an average has been 21%, but over the longer period, it's been closer to 13-14% kind of return. And again, slightly better than Nifty and Nifty 500 in terms of returns. So with that, we come to the end of this presentation. So as I said, this is a equity fund in the index format. So it will be fully invested, minimum 95 to 100, but practically very close to 100% will be invested at all points in time. Uh, and all the special features are available. Just to sum up this particular fund, as I said, the universe is Nifty 500. Nifty 500 per se is not very diversified because some of the large stocks have a higher weight. However, equal weight puts money in all 500 stocks. Therefore, it is far more diversified. From that perspective, relatively, it has reduced risk. But having said that, it has higher exposure to mid cap and small cap. In fact, 50% exposure to small cap and 30% to mid cap. To that extent, when you compare it with Nifty 500 or most of the other strategies in the market today, which will be probably heavy on large cap, this is more or high on risk and return. So those are the key differences. The portfolio tends to be very different. So you may have a possibility to kind of add unique stocks to your portfolio. You have a distinct 20% allocation, 20-30-50 split, 20% large cap, 30 to mid cap, and 50 to small cap. This allocation generally you will not find in the market when you look at other strategies. You can make investments even through SIP, STP, and other modes. Of course, relatively low cost as well. In our opinion, I think this will be suitable for those of you who think that India will do well in the longer term. Indian economy will do well, Indian markets will do well, but at the same time, you think that doing well does not mean that only few stocks should do well and they should lead the returns. On the contrary, a lot of stocks, including some of the medium-sized, small-sized companies, also could do well in India going forward. So if you have that kind of view on the market, this would be a good product. Second, if you think that I understand the risk that it has higher mid cap and small cap, I understand that it can have volatility in the near term that can be higher risk, but I want to take that exposure for the longer term. Let me add this to my portfolio. You can look at that regardless of what can happen in the near medium term, but with a clear understanding and expectation on those lines. Third, if you think that my existing portfolios are all large capish, they are all revolved around a few set of stocks. As I said, most of the funds and portfolios will have the usual set of 15-20 stocks, which you will invariably find in most portfolios, and there will be a good amount of overlap. So on the contrary, if you think that here is a chance for me to get into a wider number of stocks and therefore to diversify, again, this will be a good strategy for you to look at. The scheme is already open, the NFO. It is closing on September 4. Being an index fund, there is no exit load also. You can enter, exit any time. Of course, capital gains and other things will be applicable. And the minimum amount is 1,000. And of course, SIPs are also available. So with that, I will conclude. So just one word about Nippon. So we are the fourth largest asset management company. We manage roughly close to about 5.3 lakh crores now. Out of that, in the passives, in ETF and index funds together, we manage 1.6 lakh crore. We are one of the largest players in both mutual funds in general and in passives particularly. And we have a total of 43 funds across ETFs and index funds already, and these funds are across equity, fixed income, commodities like gold, ETF, and gold, silver, and within each of those equity, for example, there are different types of products available to suit your various requirements. So we do think that we have reasonably strong credentials and experienced managed team. We've been managing funds and handling passive investments also for a very long time, and this we think is a unique differentiated offering we are bringing to the market, and we think we have explained in fair bit of detail. And for more details, you can consult your advisors, you can check with Bajaj Finance. And thank you once again for joining this webinar, and I thank the Bajaj team for having given us the opportunity to talk to all of you. Thank you very much once again. And those are the statutory disclaimers. The most important thing that you need to keep in mind, we showed you a lot of data on the past track record. Please keep in mind that past returns and future returns can be very, very different. So you will have to read all the documents carefully before making an investment choice. The scheme information document. Please peruse all the materials that we have put out on these materials. Go through all the details and take a informed investment decision. So with that, thank you very much for your time. I will now hand it over back to the Bajaj team. Back to you, Abhishek.
Yeah. So once again, thank you so much, sir, for the insightful session, and it was really a very insightful session. I am sure that our viewers must have got a clear picture about the latest NFO. And so beyond this, already have addressed all the questions and query the customer. As a customer, I will be having in mind, but there are few questions from my viewers, so I just share with you, so that you can address once again in a simple one or two liner. So basically, a few of investors are asking like, what type of investor or investment behavior in this NFO designed for?
So, which is the last point that I made, that this will be suitable for those who are thinking that in the long term Indian equities will do well, and within that, I need a relatively aggressive product, in terms of risk return profile, which can potentially outperform the broader market over a period of time. But at the same time, they should understand that in the meantime, given the construct of the product, that it has more in small cap and mid cap, it carries that higher risk, it could have that higher volatility. Once they understand this, but they're looking at the medium long term for potentially higher returns. So those are investors who would be ideal for this particular fund.
Right. Thank you, sir. So there is another question from one of our other viewer, that is, as an investor, what risk should I be aware of with this fund, and how is the fund designed to handle these risks?
So again, clearly, as I said, 150% small cap exposure, 30% mid cap exposure. So relatively within equity, this construct is aggressive. And even within small cap, we are going to invest in 250 stocks, right? So you will have the smallest of the small cap companies also. So we don't do any filter on quality or anything like that. So it's quite possible that a few set of stocks may not do well, few stocks will do well. As a collectively, as Nifty 500 equal weight, uh, you saw the performance in the past, how things have panned out and stuff like that. But even in the past, you would have noticed that during periods where equity, for example, let me say 2018 and 19. So both the years, 2018 and 19 calendar years, equity returns were very muted. So markets were very flat. Only few stocks did well. Mid caps, small caps underperformed. So those kind of market scenarios, if they were to come through in the next, in the medium near term, so during those times it could underperform. So we should be aware of the fact that this has higher exposure to mid and small cap. To that extent, it makes the product relatively high on risk and return. Yes, potentially it can give higher return over a period of time, and in good times it can give phenomenally good returns. But you should be prepared for the opposite also to happen. So suppose you invest and you find yourself in the next 6 months or 1 year, this fund is underperforming. It can happen to any fund, any strategy, right? So you should be prepared. So that is the very basics of equity investments per se, especially for a product like this, which is, in terms of construct, aggressive.
Very true, and totally agree with this. Fair enough. So mostly questions you already have covered. So one last question, if I talk about, because many of investors already you have covered this in the starting of the session. But what mode of investment would you recommend to take the advantage of this fund, given the current market behavior? Because we know it's an all-time high market and what volatility is on peak. So what do you suggest?
So generally, we refrain from timing the market. Okay, so market being at a high, historic high, is data, is a fact that, today we are at whatever 80,000, 81, whatever it is. That is a number, right? But is this the highest? Can markets go to 90,000, 1 lakh? When will it take a correction and then go? Will there be a time correction, or whether it will keep on going up? All those things are extremely difficult for anybody to guess. Okay, just to give you some context, even last year around this time, markets had already gone up. At that point in time, it was again at a high, historic high, peak, earlier peak. From there on, markets have run up further, maybe 40%. Small caps have run up 50, 60%. So these things are, we can analyze on hindsight, but it's very difficult from here on what will be the path and how things will go. So that generally is a futile exercise. So therefore, what investors need to focus on is their portfolios, and given the nature of this product, where does that fit in? As I said, for example, if your basic hypothesis is that I'm looking at the long term, right, then what happens in the next 3 months or 6 months is not that material. Someone else says that I'm anyway going to make SIP. So how does it matter whether you start now or after 6 months? Right? So on the other hand, somebody says that I have anyway, a lot of my investment is anyway in equity, it's all large cap, so I'm exposed to a particular type of risk. There are a lot of times when large cap, when FPIs pull out money, large caps will get impacted more than even the broader market. So that person could say that, okay, let me add something like this, let me diversify my portfolio. So it could have different appeal for various types of investors. So one has to see it in the context of their own objectives, their own risk return profile, and then see, rather than have market as a starting point. Okay, which in itself is very difficult to do. So I would discourage investors to do that and have that as the starting and the ending point. Rather, focus on all of these other things which are more important.
Fair enough. So I think this is a matlab, detailed explanation you have provided to all the investors, and this is definitely going to be help them in a broader view. So once again, thank you so much, sir. So if I'll talk about in today's scenario, so we discussed about what are the index fund, what is NFO is all about, and if I'll talk about Nippon India Nifty 500 equal weight index fund. So definitely the strategy the MC is following, like in terms of the unique criteria, like rebalancing of the portfolio on every quarter and giving the equal opportunity to all the indexes. Not only this, the diversification consideration, and the major part will be this periodic profit booking approach will be there. And within this fund within this fund, the investor will be having a broader approach to all the category, like is large cap, small cap, mid cap category fund within the top 500 stocks. So that is something good. So definitely what I can say ki, matlab, this fund is going to be beneficial for the investor, especially if the investor is looking for a long term. So definitely investors should go with this. So once again, sir, thank you so much for your valuable time and for your kind investment in thank you to you once again. And for investors, for your kind investment in mutual fund, download the Bajaj Finserv app, that is www.bajajfinserv.in. In and under this, you can visit the mutual fund section under the investment sector section. You can visit our website to check on various other NFOs as well from different AMCs. Thank you all, and we will see you again very soon with yet another interesting session which will help you with creating wealth in long term with investing in mutual fund. So once again, thank you, Mr. Arun Sundaresan, for his valuable time and giving the insights on this index fund. And
Thank you very much.
wish you also all the best, sir, for this
Thank
NFO.
you very much, and pleasure talking to all of you. Thank you very much.